Here's another analysis. I'm buying the $19 put, which gives me a total risk of $430 until the third week in July, the third Friday in July, in which this option expires. If I were to purchase another option, let's say I went to the $20 put option on this, now my downside risk is only $200. Of course, my upside potential is greatly reduced. However, I only have $200 of risk in an $18,000 purchase. If I went even higher, now my risk is only $160. But again, my upside risk, my upside potential is also extremely limited. Where you buy your put is up to you. Whatever you feel comfortable with. I feel comfortable with a $400 loss on the stock. And I'll explain to you another reason why I feel comfortable with that. On an $18,000 purchase, if I lost $430, I'd be okay. It would not bother me. But here's where it gets really interesting. In order to demonstrate exactly what I'm talking about here, we have to go to the Think Back page for just a second. The Think Back analysis tool in Thinkorswim allows you to take a look at what option prices sold for at a time in the past. So let's take a look at what Starbucks, let's take a look at their chart just for a second again here. And let's say you are one of those enthusiastic people who purchased Starbucks stocks back here for $40 on November 16th, 2006. Now tell me the truth. If you saw only, let's see, now I gotta do this. If you saw only this part of the chart, what would you think about this stock? You think, hey, this thing is going up. This could be going up for quite some time. So let's go back to November 16th, 2006 in our Think Back tab. Let's call up the Starbucks symbol. Let's change the date to November 16th, 2006. At that time, we had the November options, which only had 1 day left. We had the December options, which had 29 days left. All right, well, let's take a look at the December options because it still had 29 days left. At that time, if you were to purchase the Starbucks stock at $39.43, you could have purchased the 37.5 strike priced options, the put options, for 90 cents. So 1,000 shares would have cost you $39,000. The insurance would have cost you 90 cents a contract times 10, which would have been times 100, which is the multiplier, which would have cost you $900. So we just go up to 10 shares, to 10 contracts. Okay. So at that time, the 37.5 would have cost you $900. That would have provided you with some protection at least. You would have still have lost the difference between the strike price and the price of the stock, which was $39.43 minus $37.50. Your maximum risk on this trade would have been approximately $2,500. That was probably not an acceptable risk to me. It may have been to you. I probably would have purchased the $40 put, which was a little bit more expensive at $1.90. Now that would have cost me $1,900 in order to protect those that stock. However, that stock cost me $40,000. So $1,900 of insurance would have been a little bit more expensive. However, let's see what would have happened the very next day. And remember, I'm buying this option here. They put the mid price in here, which I may have been able to get for $1.85. Let's see what happened the very next day. The very next day, the market opened, and let's see, I think I gotta bump up this date here. There we go. The 40 options that we purchased for $1.85 are now worth $2.90. If we take a look back here again, let's bump it up one day. The stock opened up down here at $37. If we continued, you would have seen the stock continue to decline until it hit $29. I'm sorry, we're over here. Would hit $35 just a few days later. Remember, we purchased the stock here at $39.43, which was at the close, and by December 1st, this is December 1st right here, it would have been trading at close to $35.25. So let's see what would have happened to our $40 put on December 1st. On December 1st, our $40 put would have risen in price to $4.90. Actually, we could have sold it for $4.80. Now remember that on the 16th, we purchased the option for $1.80. Well, at that time, no, I'm sorry. I'm not sure that's true. Let's go back to the 16th here for a second. Yeah, on the 16th, we bought it for $1.85. And we fast forward to December 1st, it was worth $4.80. That's approximately a $3 difference. How much did we lose in the stock? Well, the stock went from $39.43 down to $35. That's about a $4,000 loss. However, we gained a little bit, almost $3,000 in the price of our put option. Now at that time, I'm sorry, we're actually in December. Our $40 put option was actually $4. We could have gotten $4.80, so about the same price. So we would have made close to $3,000 on our put option because we bought the December 40 puts. Now, if we bought that would have given us $3,000 in protection on the downside of a stock that just dropped $4,000. So we still would have had a loss on the stock, but we would have gained $3,000 on the put option. Let's say we bought the 37.5 put, which was cheaper at 85 cents. With that $37.50 put option now is $2, and we could have sold it for $2.30. That's a difference of only $1.50. So we would only had $1,500 in protection on the downside on a stock that dropped $4,000. The idea is to select the strike price on the put side for protection as insurance on your position in which you feel comfortable. My goal when I'm purchasing stock initially, this is on my opening position. If I were to purchase this stock at $40, I would want to have the stock prove itself and limit my initial risk to less than $500 generally. Now let's do the opposite. Let's say that we actually decided to purchase the stock. Let's go back to our current positions here. And let's say, like I did, I purchased the stock right around $16. And this was on May 13th.